morning, everyone. Thank you for your time. My name is Melvin. I'm the CEO of QCP. We trade a lot of Bitcoin options, Ethereum options, and this is why this topic is really interesting for all of us. Why? Because if you were to think about institutionalization of the digital asset world, and for it to become a financial instrument, tokenizing, leveraging, these are very fundamental things. And today on the panel with a very diverse group, because I think across this topic, it will cut across a few industries. So it'll be very interesting for us to hear from all of them. So without further ado, let's get cracking. Helen, I'm just going to ask you, when you look at an asset, what makes it truly a good collateral in your world, in the world of insurance? And how close are crypto and digital assets to that standard?
Thanks, Melvin. It's a very good question. My name is Helen Yi. I'm the CEO of Qubit Underwriting. Qubit is the first and only Lloyd's cover holder in Asia Pacific, and our underwriting authority also covers Middle East, including Dubai and Abu Dhabi. 99% of our business is to provide professional indemnity, D&O, all these financial line insurance policies actually to digital asset players or anybody deploying blockchain technology. So this topic is very dear to my heart for two reasons. One is we are the true bridge between the traditional finance, which representing insurance, but at the same time, we're providing the coverage, or we're the risk taker of a new economy, which is digital assets. So for many years, insurance industry is constantly looking for new capital to support the risk taking. And we consider ourselves very experienced in gathering that capacity. So at the moment, globally speaking, for the reinsurance industry, for example, we leverage about, nearly 300 billion, in terms of fiat money as collateral. How much do we use Bitcoin at the moment? My best guess is probably around maybe a couple $100 million US. And that is, again, playing in the gray area, which is unregulated. So why is that so? The reason is coming back to the question you asked, Melvin, is what is considered a good collateral in a highly regulated financial industry like insurance? So the first and foremost is actually stability. So we need the underlying assets to be as less volatile as possible. The second reason is we need the assets to have very clear legal certainty. Who can claim it, who owns it, who guards it, and when we actually call for the assets, and who can release it, who can sell it. The third one, obviously, is we need to have transparency. We need to have a transparency, both in terms of where the assets are, how safe it is, but also in terms of valuation. Who does the valuation? Is the valuation accepted by the regulators worldwide? And the fourth one, I think, is regulation, unfortunately, is in a lot of jurisdictions, including, we operate in Hong Kong. The Hong Kong Insurance Authority has a very clear guidance for any regulated insurance entities not to touch anything crypto. So that actually possesses a lot of barriers for the insurance industry to leverage and to use the vast, the availability of the very liquid assets that we have at the moment.
Thank you for your response. I'm a trader. I have tension with what Helen said, because if the asset doesn't have volatility, I don't have work. But going over to you, Sabrina, from your perspective, what type of tokenized assets are realistically eligible for central counterparty clearing? And how should risk models adapt, considering that I like volatility?
Big question, little time to answer it, but thank you. And just to frame the question, we are operating an exchange currently in the UK, derivatives exchange, and setting up a derivatives exchange as well as a CCP under ADGM at the moment. So the question that you're asking around collateral is really at the core of a central clearing counterparty and clearing house. So, and I would even say you use the word risk management in your sentence. The problematic of a clearinghouse is really a risk management problematic. So traditionally, and I'm going to use a lot of the points that Helen has used, because collateral has got certain virtues, right? It needs to be valuable. It needs to be something that you can value easily. It needs to be liquid. You need to be able to partition it to each of the clients. So there are certain attributes that you're using in insurance that we also are using in the world of clearing. So some of the aspects that you described are very commonly used in our world as well. Traditionally, CCPs have been using cash and securities, but we see that that world is changing. And why is it changing? Is because also you have the movement of monies around the clearing ecosystem that increasingly institutions want to use 24/7. And if you're looking at the crypto markets, the markets are already 24/7. So you need banking rails that really enable that 24/7 movement, but you also have now tokenized forms of collateral that can operate on blockchain 24/7. That's really changing the way that we're thinking about collateral at the clearinghouse level. So what assets? Obviously, digital assets are there natively, but we're seeing increasingly tokenized forms of securities. We're seeing, of course, the use of stable coins. You would have seen from the CFTC some announcements this week in terms of expanding the permissible level of the permissible types of collateral that they will consider for derivative CCPs. So all of this is changing gradually, and it's underpinned by the need to be much more fluent and rapid in the settlement cycles as well, rather than waiting for T+1 and building a lot of risk in the system. It's also heavily influenced by the needs for 24/7. It's also heavily influenced by the progression in payment technology as well. So I'm sure all of this we will unpack, but I would summarize liquid. Something that has legal certainty is very, very important, that you can really apportion it per client account or principal accounts and make sure that you tag the assets properly. And all of those things are really relevant in a 24/7 world and in a world of proper risk management.
Well, thank you for that. I think when we look at digital assets and we think about it becoming acceptable collateral from a CFTC perspective, I recently put in an application to submit that Pokemon cards should be considered as trading collateral. But then if you think about it from being a custodian of the Pokemon cards, that's a real big issue. But over to you, Andre. How are regulated custodians really thinking about tokenized collateral and the enforceability, especially in multi-jurisdictional issues?
My name is Andre Meitzen. I'm a group CEO and co-founder of Bitcoin Swiss, which is the oldest crypto financial institution in Switzerland. So, you asked a couple of different elements in that question, and I think we need to unpack it a little bit, and I can relate to what has previously been said. So, first of all, what is a tokenized asset? So you usually have like an issuer of a tokenized asset, and there it already starts that you need to know, what is the underlying asset? How is it backed? Who is the issuer? So you need to do some sort of proper due diligence when it comes to that. So if you, for example, have $100 worth of stable coin, is it really backed with $100? Is there some sort of an audit process? How is it working with the redemption and all of those kind of processes? So understanding what is really the asset in itself, and then of course accepting it as collateral. One thing is the legal certainty, and that has already been mentioned. The other one is, in crypto there is a saying, not your keys, not your coins, right? So if you do not really control the private keys of a tokenized asset, you don't really control it. So you might have the legal clarity that this is your asset, but at the end of the day, if you cannot really control it, it's not really a good collateral. Because, and you also touched the topic of pricing itself. How is a tokenized asset priced? I think that's extremely relevant. What is the pricing sources of it? Because one thing is you have the control, then the pricing, and the other one is the enforceability to do a trade execution. So if, for example, you accept a tokenized asset as a collateral, price drops instantly, and that might not be with US dollar or so on. Maybe in the longer term, but in the short term, other assets are more volatile, and the more exotic they are. So you need to be able to access those funds instantly. So if you just rely on a third-party custodian, or if you have a multi-sig setup and all those things, it doesn't really work like that, right? So you need to be able to execute a trade in the moment where the price drops. And if you're not able to do that because you don't have a fully redundant 24/7 available kind of trading setup, then that could be, of course, very dangerous, and you would incur losses in those kind of scenarios. So I think it's really a combination of different factors that are relevant if you really want to pledge tokenized assets or accept them as collateral in this kind of ecosystem, and you need to have the proper infrastructure in place for that.
Yeah, I think we've kind of hit the nail on the head on a few fronts. We were talking about risk in general. There's counterparty risk, and there's all the forms. I think one way to take this away is really trying to connect TradFi and DeFi and in the collateral system. So, Redwan, what do you think are the interoperability standards that have been emerging that allows these worlds to merge?
Thank you very much. So I'm Redwan Meslem. I'm the Executive Director of the Enterprise Ethereum Alliance. We are a trade organization focused on facilitating adoption of Ethereum for large enterprise and institutions. So we have members that span for large TradFi to also high growth Ethereum startups. And we've done some work around standards, either technically or also education. And so to answer your question, I think what I love to say to more financial crowd is like, there's no technical problem that we cannot solve. Nowadays, in terms of interoperability, which means, if you tokenize an asset that's going to live on one ED exchange, how are you going to make sure like this can continue to be living and communicating with other systems? Because if we tokenize everything but create silos, it's useless. And what we want is having capital velocity. And that's where we see, especially in clearing and in collateral management, some pretty good use cases. Nowadays, we see like few standard emerging around like tokenization. And actually, we're going to publish a paper in a couple of weeks on that to really provide some clarity of those different technical standard. You have ERC 3643 that's been like getting a lot of traction. There is some other standards in the works that have like different design. I think what is going to be very important is to make sure like we keep having those conversations with different participants in the ecosystem. I'm from the Ethereum world. I've been doing some TradFi at a certain point, also like some manufacturing, everything. But I think in the Ethereum and Web3 ecosystem, we sometimes too much of an engineering conversation when actually it needs to be a business conversation. And the more we have those, the better we can serve actually, like your different like companies or institutions, to make sure like those assets and what we do are going to still being very interoperable, because that's the key of every efficiency.
Fantastic. Now we've covered everyone's specialty topic because that's what we try to give you. What is the most underrated regulatory or legal change that could accelerate adoption tomorrow, in your mind?
I'm happy to kick off.
Go.
Unless Ellen, you want to.
You go ahead.
Underrated change. I think what's important, and I'm really going to be a little bit myopic about our world of clearing and exchanges and regulated exchanges and clearing. The foundational aspect of why those markets are global is equivalence between the various regimes. So what we are seeing, especially as we are talking about today, the tokenization aspect of collateral, the mobility of collateral 24/7, I think the equivalence regime between the various jurisdictions is terribly important. If you want to create a global ecosystem, having parity and recognizable equivalent regimes, I think is very paramount. So often this is sort of implied in the conversation, but I'd like to call it as an explicit piece because it is very, very foundational for all of the global cleared markets, the global exchanges that connect, members from and participants from across the world. And equivalence is that bedrock and foundation for them to be able to do so. So it's a bit of a technical point, but I think it's also, to your point, an underrated point.
Right.
From my perspective, I think tokenized collaterals has a lot of technical superiority as we sitting here, we can understand. Of course, that technology is not perfect yet, and it's still actually changing. So from our perspective, from a very highly regulated industry perspective, one thing I think will actually make a lot of difference is whether we can have that equivalency, but not across geographics, but across financial institutions. So if we think about how currently the collaterals work, at least for the insurance industry, is we put a lot of that fiduciary duties and a lot of that regulatory burdens to the banks, because we believe banks are as equivalently, or if not more so, regulated than the insurance industry. So if the banks gives us a letter of credit, we're thinking it's good, right? Of course, there are scams and a lot of the cases happened in the past, but fundamentally, I think insurance regulators believe the banking regulators are as good. However, when we are talking about tokenized collaterals, the first question, and what we cannot answer all the time, is who is going to be the custody? It's not the banks. Banks are not doing it, right? They don't have the infrastructure, they don't have the experience, they don't want to do it. So how can we actually have the equivalently regulated entity as credible as banks, but they are digital asset native custodians? They can actually resolve all the technical questions, and they can assume the same level of fiduciary duties, the KYC, the travel rules, everything. All the regulators will say, yes, we actually accept that. I think that is the biggest challenge. If that can be resolved next year, that opens the door to a lot of TradFi financial institutions to use the tokenized collaterals.
Andre?
I try to keep it short. It's to answer your question, I would say the MiCAR framework, because everybody's focusing these days on the Clarity Act and so on. But I mean, coming from where we came from, like starting a business in the industry 13 years ago soon, I mean, having regulatory certainty across different jurisdictions and in Europe with all the member states, I think this is quite a major step in the right direction. Of course, it's being attacked now from all different angles because they tend to already start with different finishes in the different jurisdictions. But overall, the idea, I think, is a great step in the right direction. And I think this regulatory certainty needs to be done across different jurisdictions in order to have this clarity.
Thank you.
I think we need to look at everything in form of risk management and counterparty risk. And I think I could quote like Nadine Shakar that was saying that at Sibos recently, that in DeFi, in code we trust, is not sufficient when you go into the real world, I would say. And I would say to the crowd here that is more like financial crowd, that the ecosystem, especially Ethereum, like really opening the door like never and having conversation to answer your needs and see how we can integrate that. And I think for the last couple of years, I love to say like we've been taking care of the baby. But now as a teenager, they're able to go to the world and they have really like the maturity. And I see a lot of very exciting works either around privacy standards, because that's something we haven't touched, but that's a reality especially for you. You don't want to expose all your position. And so there is a lot of work being done right now by the community. And so we're really willing to have more dialogue. And I think that's what's going to really help the next at the end. It's really breaking the walls. The more we discuss and the more we have conversation, and the better like the regulation is going to be.
All right, fantastic. Lightning round. We'll start with you, Red One. But if we fast forward to 2030, will tokenized collateral just be another tool inside banks? Or is this going to change the way we do leverage, credit, and liquidity? Red One?
Okay, so the dream in 5 years, you could tokenize almost everything. You have affordable housing in New York City, or you have some the equity of your home or the equity of your car, and you can really like tokenize all of this. I think that could be some pretty exciting topics in the future.
Fantastic. Andre?
A lot of things can happen in 5 years, but usually they also tend to take longer. So I think it still takes some time, but it will certainly be another like tool in the toolkit, and most banks will play around with it for sure.
Fantastic. Sabrina?
Yeah, no, very quick parting words. Absolutely. I think by 2030, we will see a lot more tokenized forms of collateral. And we haven't spoken at all about the risk-reducing factor of the collateral velocity, the quicker settlement. And I'm not talking instant settlement, because that's probably some years away, but a swifter settlement cycle and the counterparty risk reduction that can result from that in the system is also a very important dimension. So perhaps another time we'll have a chance to talk about that, but I think absolutely we're on march to see a lot of this.
All right, and finally, Helen.
I think in 5 years of time, we will have more sophisticated understanding and the products in terms of tokenized assets. Today, we're talking about the tokenization as if everything is the same. But in 5 years of time, we will understand what are the liquidities, what are the qualities, and how can different assets, once tokenized, to be used differently. So in 5 years' time, if there is any achievement, what I wanted to see is at least the first tier, very quality assets being tokenized and being used very widely by the traditional institutions as tokenized as collateral.
Well, with that, I bid you a good day, and then thank you to the panelists. Thank you.
Thank you.